Welcome to Module 5 of the Antioch Baptist Church Virtual Entrepreneurship Conference 2021. My name is MJ, and I will introduce our first speaker, Kwesi Rogers, who will speak to you about how factoring can be an alternative source of financing to a growing business. Kwesi Rogers began his career with Federal National Payables in 1992 and was promoted to the position of president in January 2006. After 26 years with the company, now known as Federal National Commercial Credit, Kwesi went on to become president and CEO of White Oak Business Capital in 2018, and just last year started his own enterprise called Core Capital Corporation. Kwesi Rogers works with the owners and the management teams of small businesses that seek the financing solutions to provide short-term working capital to help them grow and scale their businesses. You can visit his website at www.korecc.com. Kwesi will discuss his insights on alternatives to bank financing, and I will turn it over to him now.
MJ, thank you very much for that warm and thoughtful introduction. MJ said 26 years, so just so all you know, I started my career when I was 5 years old. So I'm only 31 years of age, despite all the gray hair that you see. Certainly a pleasure to be here with all of you today, albeit virtually. And so we're going to talk a little bit about alternative financing and sort of about the process that an entrepreneur goes through and when he or she should seek out alternative financing. So, I would, when you start off your company, most early stage companies are in, what I would refer to as your survival stage. So, you're focused on, what's in front of your nose, and your primary goal is to secure some revenue. So that you can grow and scale the company, because without revenue, the company dies. So, I would oftentimes I compare it to the dog chasing the car. And if you've ever seen the dog catch the car, the dog next question is, what do I do now? So as I explained, many entrepreneurs, it takes sometimes years of focused effort to win your first substantial contract. And when you do, you probably spent more time and money than you planned on in accomplishing this goal. But now, depending upon how substantial the contract is, your challenge becomes, how do you finance this contract? And if you have been pursuing business with a large corporation or government that extend terms between 30 and 60 days, you can expect to incur 4 payrolls before you get paid. Let's go through that really quickly. Generally, you're allowed to bill monthly. So you work for 30 days and then you invoice for the services that you rendered. Then best case scenario, you probably get paid 30 days later. So there's your 60-day window. In the meantime, your payroll is probably every 2 weeks, so you've incurred 4 payrolls. So you have to come up with money to the extent you don't have it already to meet those payrolls. Otherwise, the employees walk and you no longer have a business. So we can't have that. So the entrepreneur oftentimes asks, himself or herself, what do I do? For many entrepreneurs, the answer happens to be factoring. If you were to look in the any finance book, this definition that is on the screen is probably all you will see in the finance book. Factoring, while it's used by many entrepreneurs, it's not talked about extensively in your business courses. So essentially, factoring is an entrepreneur has rendered a service or delivered goods and has invoiced. This creates what is known as an account or account receivable. Sits on their balance sheet as an asset. Sits on the balance sheet as an asset because that asset is expected to convert into cash, and we can quantify the amount of cash that it will create in a certain period of time. So the problem being that account is going to turn into cash 30 to 60 days from now, but the business has a cash need right now. So the business owner can sell or present that invoice or those invoices to the factoring company at a discount in exchange for the cash advance that the business needs today. The answer is oftentimes to the quandary is oftentimes also asset-based lending. Asset-based lending and factoring are very similar. In the case of factoring, factoring company is focused on the invoice or the invoices. And they take that invoice, they underwrite it, and they provide a cash advance. In the case of asset-based lending, the primary difference is the asset-based lender basically lends on a pool of assets. That could be accounts receivable, that could be equipment, machinery and equipment, it could be inventory. But they generally go through the same process and are relying upon assets that they can quantify a certain value to. And they will make advances based upon the value of those assets. Now, there are other financing sources available to entrepreneurs that we'll go through quickly. My task today was really to talk about factoring and a little bit about asset-based lending. But according to the Kauffman Foundation, which is a leading non-for-profit serving entrepreneurs, the number one source of capital for entrepreneurs is personal savings and credit cards. It works well. However, many entrepreneurs get themselves to the point where they've exhausted all the personal savings and have run up the balances on the credit cards. Problem with doing that is it hurts your credit score, so it makes it difficult to induce other lenders to provide financing. Number two is banks. And when I say other lenders, obviously if you've exhausted your personal savings and the credit card balances are high, a bank's going to have a difficult time approving you for a loan. So just keep that in mind. Number three is professional investors. The caveat here is that most professional investors generally lend or invest in companies that are started by other successful entrepreneurs. Very few entrepreneurs in their first venture are able to induce professional investors to invest unless they have some phenomenal technology that investors believe will change the world, if you will. Friends, family, and fools. And that's an actual term. I didn't make that up. You'll see that all over. And friends, family, and fools will generally invest for people they know, people they want to see succeed. Obviously, the challenge with that is if things don't go as planned, obviously that can place a strain on your relationship with friends, family, and fools. And the last number five is there are various government programs that are designed to help entrepreneurs finance and scale their business. So most entrepreneurs, when they're faced with the quandary I described previously, they go directly to the number two source on the previous list, which is banks. Makes sense. Growing up as a kid, if you ask me what banks did, I'd tell you that, a bank is a place where my mother and father placed their deposits. And it's my understanding that, banks make loans. And that's all I could tell you. And that's all a lot of people can tell you. But, so the first thing they think of is they go to the bank, and most entrepreneurs haven't done a lot of research into, what it takes to qualify for a bank line of credit in adequate amounts to support their business operation. So, many entrepreneurs are declined by banks when they first make application, and many entrepreneurs take that personally. I would encourage you not to take it personally, because in many cases it's just a case that your business at that particular point in time does not fit in the risk parameters, the risk box designed or for that particular bank or banks in general. And you have to really think about it. Banks are the most highly regulated industry in the country. So there are specific guidelines when it comes to their lending. So, and if you want to take it a step further, they are lending out deposits. So they're lending out the money that you deposit into the bank, the money your kids deposit into the bank, your grandparents, your aunt, your uncle. And those deposits in many cases are insured by the government. So there are going to be specific guidelines as to who the bank can lend to and under what circumstances. So many people ask, banks and other lenders, what criteria do they go through? What's the analytical process? So at a very basic level, almost every lender at some level goes through the 5 C's. The 5 C's is taught in almost every finance class, almost every business class. And so the first is character. And really, when you talk about character, they're going to be looking at, does this entrepreneur, do they pay their bills? Do they pay their bills on time? Do they satisfy their obligations? Are they responsible, law-abiding citizens? Credit. That, of course, goes back to, that ties in with character and, does the business owner pay their bills on time? Some lenders will look at credit because, in many cases, as I mentioned earlier, an entrepreneur will have a business plan. The business plan will oftentimes have various milestones that are based on time. And in a lot of cases, based upon how the market conditions change, it may take you a little longer to secure your first contract. So you may have to spend more money. You may have to carry the business for a longer period of time, and that may affect your ability to satisfy your personal obligations. So a lot of lenders will take that into consideration. Just know that as a business owner, your individual credit score will have a big impact on your ability to finance the business. Cash flow, lenders want to know, do you have the cash flow sufficient enough to carry out the obligations, to meet the requirements, your contractual requirements to your customers, so that you can get paid and pay back the loan. Capability. Are you capable of carrying out the services that you've been contracted to carry out? Do you have the technical expertise? Do you have the processes and procedures to be successful as a business? And finally, collateral. Do you have a collateral that the lender can liquidate in order to pay back the obligations? Now, those are the 5 C's that everyone talks about. I really enjoy JP Morgan's 3 C's, and those and 3 P's, of course. The 3 C's are character, character, and character. JP Morgan was a big believer in lending to people he believed, would, no matter the circumstances, would do whatever they could within their power to make sure that they paid back the obligation. And then the 3 P's from the lender's perspective are, can they pay, will they pay, and can I make them pay? And whether any lender realizes it or not, they all go through that exercise. So what does the factoring company look for? Well, I thought you'd never ask. So first thing the factoring company looks for is, does the borrower, does the entrepreneur have credit-worthy customers? What does that mean? Well, in many respects, it means, is the entrepreneur doing business with an entity that has shown over time both the willingness and the ability to make good on obligations of the size that they are going to have extended to this particular entrepreneur. So for instance, the federal government over time, over a long period of time, has shown that they have the willingness and ability to make good on their obligations. I would argue that today, Amazon has shown the willingness and ability to make good on their obligations. Just 2 examples. And the second thing the factoring company looks for Are the assets of the borrower unencumbered? What do you mean by unencumbered? Well, great question. What do I mean by unencumbered? Um, a company has assets, and there is a body of law that allows lenders to place lien on assets to secure their place in line to ensure that they have legal right to the assets if they need to use those assets to pay back their loans. It is no different than when you go to apply for a mortgage. Until you pay off that mortgage, the bank has a first lien position on the house, which is the asset. If you go to sell the house, the first proceeds go to the bank to pay off the mortgage. The balance would go to you. This process works the same way in the business world. So and then lastly, can the factor obtain an assignment of the accounts receivable? What do you mean by an assignment of the accounts receivable? Essentially, the factor will send, and we'll go through this in a little more detail later in the presentation. The factor will essentially send out notice to the borrower's customers, notifying the customer that the receivable has been assigned. And this notification will require that the entrepreneur's customer will pay all the invoices due to the factor in order to retire the obligation that the customer has to the entrepreneur. Application process. The application process for the factoring is in some ways similar to a bank, in other ways different. We ask for some of the same information. So we ask for financial statements. Financial statements being the income statement, which talks about the income as compared to the expenses and how much a business makes or loses on a monthly basis or over 6 months or perhaps a year. Aging reports. You generally, businesses have two types of aging reports. Accounts receivable aging report shows who owes the business money and how long they've owed the money. Like, has the money been out 0 to 30 days? Has it been out 31 to 60 days? Has it been out 61 to 90 days? I can tell you that for most lenders, there's a magic day. The magic day is day 91. Day 91, that asset has a much smaller percentage chance of paying than invoices less than 90 days. There's empirical evidence to that. And that's why lenders place less value on receivables that are over 90 days. And then you have your accounts payable aging, which is the reverse. It shows, who the business owes money to and how long the business has owed that money. Customer contracts, and then, sort of personal credit and background checks for management and the owners. Keep in mind, as I go through this presentation, entrepreneurs often say, the business is applying for credit. Why my personal credit? Why all these things are attached to, why are they all attached to me personally? Well, small business is driven by the entrepreneur. And there is no separating the business and the person. A small business, by definition, is not like a large corporation where if someone is removed, someone goes away, the business carries on. The business is really driven by one or a small group of people, and that's why lenders really don't separate the two. So I qualify. Show me the money. It's my favorite slide, if you can't tell. Last steps in underwriting. As I mentioned, the factoring company will take a security interest in the assets of the borrower. That just means they file a first lien, just like the bank would against a house when you apply for a mortgage. The factoring company will notify the borrower's customers to pay the invoices directly to the factor or their designee. And as the borrower submits invoices to the factor, most factors will go through a process of what we call verification. They'll just verify that the account debtor or the customer has the invoices, that they're in good order, and they plan to pay them. So one of the benefits of factoring is that, obviously it allows you to scale your company quickly, by having access to these cash advances that allow you to finance the business operation as it grows and as it scales. Because factoring, generally speaking, your availability to cash increases in lockstep with your increased sales. It's also, let me go back for a second. We didn't really talk about this in the slide, but it's also the case that, as opposed to borrowing money and having to manage that and having to make sure it gets paid back, in the case of the factoring arrangement, there are certain controls in place that are helpful for a small business and go a long way to ensure that, the loan is going to be repaid. And as an early stage entrepreneur, this is helpful because, you only have so many resources, and if the factoring company is helping you implement certain controls, it's helpful in the short run, and it's also helpful for the business in the long run. So how much does factoring cost? People ask that all the time. I had a mentor earlier in my career who used to laugh when people asked the question, and he would turn it around and he would say, let me ask you, how much does it cost for you not to have the money? And for an entrepreneur, if you have a new contract that's going to bring X amount of revenue, if you don't have the financing and you're forced to walk away from that contract, or you underperform because you don't have adequate capital, the repercussions could be great, and in a very adverse way. So when looking at any financing arrangement, always think about, okay, what's the money going to cost me? And am I better off with it or without it? But to answer the question directly, generally factoring costs you anywhere between 1% and 4% of the invoice amount, depending upon how long the invoice takes to pay. What does the factoring company consider when they price a relationship? Well, generally we consider the size of the relationship. In many respects, we are considering the quality of the customer. A couple examples. Sears, while it had a great run, if you were to ask me today, is not the same credit that Amazon is today. Frontier is not the same credit at Verizon, and many credits are not the same credit as the federal government. Federal government, as I mentioned earlier, has shown over time the willingness and ability to make good on their obligations. Now, their process is a little different. So, as such, there are a lot of lenders that shy away from financing federal government receivables, not because they don't like the credit or credit worthiness of the customers, just because they don't understand the process. And then lastly, we can look at risk, whether it be industry risk. Certain industries pose greater risk than others. Execution risk, and then there's whatever financial risk that the borrower might pose based upon what the lender sees on the financial statements. How does a factoring company get repaid? We talked about this a little earlier, but just to walk through it, as you render your service or deliver your goods and you create an invoice worth $100,000 and you need money today. So you present that $100,000 invoice to the factoring company. Factoring company says, okay, I will advance you $85,000 against that $100,000 invoice. You receive the $85,000 advance into your account. So you meet your payroll and other critical obligations. The invoice pays 30 days later. So the factoring company receives $100,000. So they deduct the $85,000 that they previously advanced. They deduct, let's say for this example, let's say they deduct 2%. So they deduct $2,000. And so now they have $87,000, and they send you $13,000 in what we call a rebate. So that first advance has been paid. You paid $2,000 to get an advance of $85,000. We talked about some of the benefits of factoring earlier, but I figured it was worthwhile going through this again. It provides you with immediate cash, allows you to do business with large corporations and governments who generally require the entrepreneur to extend terms to the large corporation or government. In other words, they expect the entrepreneur to render the service over the course of a month. They then ask the entrepreneur to bill them, and then they get to take 30 to 60 days to pay the entrepreneur for those services. So you work for 60 days if you get paid in 30. If you have 60-day terms, you work for 90 days before you get paid. So the factoring relationship provides you with the liquidity to the extent you don't have that cash on hand. Some cases, having this liquidity allows you to pay some of your vendors early. So now if you have the cash to pay your vendors early, you can go to them and negotiate discounts, meaning I'll pay you early, but I'll pay you less. If I pay you early, I'm not going to pay you 100% of what I owe you. I'll pay you 98%. And to some vendors, it's very much worth their while for them to get that cash in on hand for the same reasons that you're considering or you've entered into a factoring relationship. You don't have to have outside collateral. You just have to have invoices due from creditworthy customers so that you can take what is oftentimes the most valuable asset on the balance sheet of a small business, and you can immediately convert that collateral into cash so that you can support the business operation. And lastly, it doesn't require you to dilute any of your ownership. People talk about venture capital all the time, but if you're going to build a valuable business, and that percentage that you give up can be worth millions of dollars in the end. So to the extent you can do it with factoring, it's a lot more cost effective. And with that, that concludes our presentation. You can always feel free to contact us. And if you'd like to take another look at this presentation, it will be up on our website at www.core, that's KORECC.com. Thank you very much, and wish you the best of luck in all your entrepreneurial endeavors. Have a great day.